Welcome back to OctaFX webinar. We're going to be doing our trading for beginners workshop. Just a quick sound check and audio check with everyone if everything is okay. Do let me know in the comments down below. Yeah, just a quick audio check if everything is okay. Do let me know and I will just get started. Welcome again. Hello, first timer. Yes, this is it. Whether you're new or experienced, it's always a good thing to understand what the fundamentals is to the Forex. Audio is good, loud and clear. That's perfect. All right. Good morning, good afternoon, or good evening, depending on where you are. And I would definitely love to know where you guys are watching this from. If you can type in on the comments, then I could say hello to wherever you are. Namaste. All right, this is awesome. Cool. So first of all, if you guys join in or just tune in to OctaFX, and I know some of you guys probably heard of me, but if you guys don't, my name is Vero Hinjoro, and I'll be your host for this week. And we'll be covering a lot this week. We're basically going through 3 workshops. So get ready. We're going to be starting from the very basic. India, Nigeria. Oh, handsome. Thank you. Malaysia, how are you? Pakistan. Nigeria, India, South Africa. Hello, South Africa. Malaysia. Hello, Malaysia. Ghana, Malaysia. That's good. Okay, if you guys are wondering, I am Australian Indonesian. Right now, I am in Indonesia. So that would probably give you an answer there. So welcome. This is good to hear. Everyone is coming from a lot of places. Turkey, amazing. That's good. Nice. Everyone is staying safe. Good. All right. So we'll just get rolling. This is part 1. So again, if you are a beginner, this would be the best starting point. If you are an experienced trader and you want to refresh on your basics, this will be a good one. Okay, so we're going to be talking about understanding the global market. We're not just going to be looking at the Forex market. We are going to cover a lot of different markets as well, but we are definitely going to put a lot of emphasis on the Forex market as well. Hello from Dubai. I miss Dubai. Philippines. I've never been to Philippines, but I would love to go there. That's awesome. All right, let's get rolling. Guys, if you guys have any questions regarding anything, feel free to type it in. Some of your questions are going to be answered throughout this presentation. Those that are not answered throughout this presentation, I'll have the Q&A sessions towards the end, so don't worry about it. We're going to take a look at it. Hello from Singapore. Hello. Okay. All right. Again, my name is Vero Hinjoro, and welcome back to another OctaFX webinar. This is going to be our traders workshop in English. We're going to be starting from the very basic all the way up until, to give you some understanding of what or where to look at from a financial perspective in terms of how to trade and whatnot. So I've been a full-time trader since 2004. Actually dabbled in Forex back in 2001, 2002 when I was still in uni. But full-time trader since 2004. That's when I left my full-time job as an auditor to become a trader. I've been a trader mentor since 2007. Chief technical analyst for a couple of companies in Australia as well as in Japan, as well as a global company, obviously, Global Forex Trading. If you're old enough to remember what GFT is, we were one of the first that launches online trading with a platform that's different from MT4. Okay, so I was also chief technical strategist analyst for Invest Financial Services, which is listed in Tokyo Stock Exchange with the code TYO8709, and then I was a director for my own company, which if you want to put it, I'm more of an independent analyst guy. I work in the industry, and then I left to set up my own funds, set up my own analysis team. if you want to put it that way. All right, so was a member of the ATAA, Australian Technical Analysts Association, invited to be a speaker for their anniversary. I think it was the silver anniversary, and also for the Australian Professional Technical Analysts. So yeah, I mean, basically my career spans across Australia, Asia, Europe, and America. All right, my expertise is basically in combining technical analysis from the eastern side as well as the western side. If you guys are familiar with my work, then it will be mostly Ichimoku Kinko Hill as well as Fibonacci trading methods. All right, we got some people from Indonesia as well. That's great. All right, here's a bit of a background of what I've done. I've written articles for Japanese viewer for Times.com as well, and a couple of other financial news outlet. Regular Channel News Asia. If you guys are in Singapore, Malaysia, Philippines, maybe, I don't know, but Channel News Asia should be there for you. Also in the Indonesian TV IDX. Did seminars for Invest Carnival. I know you guys in Singapore know that. I don't know if Carnival's still happening, but I know that Invest Fair is still running. Was also on the BBC UK, CNBC Indonesia as well. And there we are with the Silver Anniversary National Conference. That's where I am. Also on the radio on 1FM, also as a speaker and on a panelist for 10th anniversary for Invest Fair. I believe that was in 2016. So yeah, so I've been giving out seminars across regions, pretty much close to global, except I haven't been to Philippines yet. Would definitely love to visit that place soon. India, I haven't been. Dubai, I have given seminars in Dubai. So let's get started. All right, so tonight's agenda will be, what is a global market? We want to talk about what global markets is, why is there a sudden surge of popularity in terms of trading and investing. We want to take a look at the basics of trading. We are not going to be looking at the investing side, but we're definitely going to be looking at the trading side, which is what you guys are here for, most definitely. Going through some market terminology, and then we want to understand how to actually trade Forex, and finally how to get started. The next session is going to be on the platform side, how to actually execute a trade, how to navigate through the platforms. Those are what we're going to be covering in the future, and then we're going to take a look at some basic technical analysis as well as fundamental analysis. All right, so here's the agenda for tonight. We're just going to get started. So let's talk about global markets and their surge in popularity. When we talk about global markets, we are basically talking about a lot of asset classes here. We are talking about a range of asset classes. Most definitely Forex or foreign exchange. We want to talk about that. We can take a look at global indices such as the ASX 200, the US 30, the Japanese 225, or the Nikkei 225, the Hong Kong 40, that's Hang Seng, then DE30, which is the DAX, the CAC 40, the FTSE 100. In India, you got the Nifty 50s, right? And we're going to take a look at the commodities side, which is basically focusing more on gold, silver, crude oils. And then we take a look at future at least we understand what a future contracts is, because we are going to be dealing with future contracts. We're going to take a look at what are treasury bonds, index futures, and more. And then look, you got to understand one thing, that these products are often traded OTC or over the counter. Some can also be exchange traded as well. There's one thing that's not here, but it's the cryptocurrency. I think we are going to touch based on the cryptocurrency. If not, then I'll give a brief rundown on what a crypto is, because OctaFX does offer some of the major cryptocurrencies as well. So you got to understand one thing, when we talk about this global markets and how we trade it through OctaFX, it's commonly considered to be CFD products or contract for differences. You don't physically own it. You are basically trading the contracts for how price move. So when we talk about over-the-counter Forex trading, a lot of people mistake this for spot trading. What we're doing is actually Forex CFDs. When we talk about spot trading, you're basically normally not leverage too highly. You know, I think max is maybe 5 or 10 times leverage. Spot could be you going to the money exchanger and then get your money exchanged, or going through the banks and get it on a one-to-one base leverage. That would be also considered forex trading, but it's on a different context. It's not spot trading. All right, we are looking at spot prices, but technically we're really dealing with over-the-counter products here, which is CFD products. What are the different thing about OTC market and normal market? I think I just explained that. Over-the-counter product means every broker pretty much has their own prices, right? It's not like exchange traded where prices are governed by the exchange. OTC products are normally governed separately, depending on your region. There are several rules that applies to it. Like in Australia, I believe we are under ASIC. Okay, Australian Securities and Investment Commission. In America, you got the SEC, and then in the UK, you got the not FDA. What is it? FSA? I don't know, something like that. FDA is food and medication, I believe. Okay, so let's get started. Why is there a sudden surge of popularity? You gotta understand what's going on in the market. Following the pandemic, basically a lot of people are looking into trading in the global markets for a couple of good reasons. One of them is actually working from home, and that gives them a lot of time to look at other things, learn new skills, and that's basically what it is, right? I mean, I used to be a coder as well when I was younger. Dropped that off, then I started to pick that up again during the COVID lockdown, and basically looking at my day trading more frequently than normally what I can. Now, there are a couple of things that this happened. Number one is definitely due to the flexibility of trading hours. So these are the main focus, and I want you to remember what's laid out here, because that is basically going to be your driving force. That's basically going to be your goals going forward. Number one that people look into trading is the flexibility of trading hours. A lot of these instruments can be traded 24/5. Cryptocurrencies can be traded pretty much every day, 24/7. But one of the main reason is it gives you another extra stream of passive income, if you want to put it that way. You have that flexibility to be able to look at the market, because you have, you know, if you're working from home, you start your own schedule. That you can basically decide when you want to trade or when you want to look at the market. So that's flexibility there for you. The second thing is there's that ability for you to exploit opportunity from both rising and falling market. If you guys here are experienced in equity market, hands up. I want to see how many people are actually share trading or at least have that experience. And I want to see that from you guys on the chat, if you can fill in that you have experience in prior investing other than Forex, that will be great. Then the more I talk about things tonight, then you'll start getting to understand that it's actually two completely different thing on how you actually trade it. The next one is actually lower capital requirement for most instruments. We're basically using leverage through to do this. We are definitely going to be covering leverage a lot in this week. So we basically have 3 series this week for the workshop. Tonight's number 1. We got number 2 on Wednesday, and then we got number 3 on Friday. Okay. And then we have the better liquidity compared to the equity or share market. And that's the reason why I was asking if you guys have any experience in the equity market, because you can tell me, I'm not going to tell you, but you can tell me and tell everyone here, our friends here that's watching tonight, that liquidity in the equity market works differently. You want to get out from a share position, you got to offer it, and people have to pick up that offer. If you say you want to sell it at a certain price, you don't actually get out at that price. You can actually play around with the liquidity there, and if no one is going to be buying your stock when you want to get out, then you technically cannot sell your stock. So you got to look at that perspective. That's not going to happen if you're doing CFD Forex, because it is the most liquid financial market, if you want to put it that way. which we're going to take a look later on. So better liquidity means better execution speed. You can get in and out quickly or quicker than the equity market. That's another advantage. The other thing is that insider trading and market manipulation, which is very common in the equity market. Probably a little bit more strict in the Western world, but in the Asian world, I still find it really shocking that market can be easily manipulated, especially here living in Indonesia for close to 6-7 years right now. There are a lot of market manipulation in the stock market, and people can fall for that trap where people are just pushing price up and they basically pump and dump. So market manipulation in the currency market or the Forex market is really hard to do, because you got to look at how much money you need to basically pump into the market to move it. It's just the scale on the whole thing, how globally it works. It's very hard for someone or a particular group to actually manipulate the market. Even if you talk about the Feds, for example, the central banks, right, in your region, if they want to move the market, it's completely different on how the stock market are being manipulated. We basically rely more on the inflation numbers. We rely on unemployment numbers. We rely a lot of this economic data, which is a fundamental analysis part that has to be taken into account for a market to move into a certain direction. All right. And then we have that rise of cryptocurrency. Basically, what happened is that popularity will lead to interest in trading cryptocurrencies. You have seen that this year in particular. We heard stories about how people are making a lot of money on Bitcoin and whatnot from the investment they made 10 years ago. But if you follow the news, then there's a lot of those altcoins out there like Ethereum, Dogecoin. They're getting a lot of traction. Cryptocurrencies is basically growing, and you have to separate cryptocurrencies. Even though it has currency in it, it's a completely different animal from Forex, which is very traditional. Cryptocurrencies are based more on sentiment. It's based more on the technology behind that cryptocurrency. Okay, but I can tell you straight out the bat, if you want to invest in cryptocurrencies, the easiest way for you to do that with good leverage is through CFD cryptos. If you want to do it through the coin exchange, it gets really troublesome. I mean, you need to have the understanding of IT as well to set up your wallet, how to work things around, because you need to convert your wallet into maybe a coin tether like USDT, and then convert it to another different coin before you can actually withdraw it from your country. So it's all different. It's not so straightforward, and the easiest way to do it is through CFD cryptos. All right, let me take a look at some of the answers here. What have you guys been trading? All right. All right, very interesting. That's interesting. That's good. A lot of people are commenting on their experience in equity, and then cryptocurrencies. Some of you get started a month ago, just started last week. That's good. That's the whole point of this session. So we're going to take a look at those. Okay, so you need to understand what you're dealing with before you actually are able to invest. How do I put it? In a more comfortable way. At least you know what you're doing, right? If you understand what's the basic. Okay, so let's take a look at Forex first. This is basically our main focus, and this is where FX from OctaFX comes from. It's OctaForex, right? This is the largest and the most liquid market in the world. And I mean, if you take a look at the data from 2008, 2009, you got an estimated daily transaction which is amounting to 1.9 trillion USD, right? This is at the peak where I first started, guiding other traders in terms of learning how to trade. Back then it was 1.9 trillion USD. Right now, 10, 11 years after, It's basically 6 trillion USD market. It's more than that right now. I can assure you that. That is the amount of money being exchanged every single day. Like people buy, people sell in the forex market. It actually amounts to 6 trillion USD a day. I mean, that's a huge number. I mean, a trillion is 1,000 billion, so go figure. That's the amount of exchange happening, and this includes CFD transactions. It also includes, physical transactions where people pay for their export, imports, and future contracts and stuff like that. That's related to currency. It all amounts to that 6 trillion USD. So this is definitely more than 100 times the largest and most traded stock market in terms of liquidity, and that will be the New York Stock Exchange, right? When we talk about the Dow 30 or Dow Jones Industrial Average, that's what we're referring to. And then we have the NASDAQ, which is 100 top tech companies in terms of market cap. So as a whole, the foreign exchange market is basically what consists of the physical or digital transactions without leverage through bank transfers. For example, physical currency exchange, if you're on holiday and you are at the airport, you take your currency and you want to convert it to a different currency that you're going to. That would be included in this. You got your currency options, your put options, your call options, future contracts, and then you got a Forex CFDs, or which is contract for differences. What is referred to by most traders when we talk about Forex, the word Forex is mainly CFD based transactions. Okay, it will fall under the currency market, but different from money market, which consists of the treasury bonds. So we got a currency market. Don't mix that up with money market. It sounds very similar in terms of concept that currency is money, but money market is a different asset class compared to the currency market. So again, as I mentioned, OctaFX basically offers most currency pairs that are commonly traded with leverage through CFD platform. Okay. Next is commodity. We want to touch on a little bit about commodities here because some of you are going to be trading some of these commodities. It basically refers to a market where primary or raw products are traded. This could include hard commodity, which is gold, silver, copper, iron ore, rubber, just for example. And then you got your soft commodity, your wheat, your coffee, your cocoa, your cotton. I believe corn also falls here. And then you got your pork belly market as well. So these soft commodity prices are usually seasonal and very highly affected by weather or any disastrous events that happen. Maybe a bushfire, flooding, typhoons. It's gonna affect soft commodity prices if those kind of news pop up. Hard commodities like metals are affected by manufacturing data. So this is what you're gonna be looking for, and this is the reason why a lot of traders that trade currencies are comfortable looking at hard commodities like gold, oils, silvers, because they are looking at the data that's going to affect currency market as well as this commodity market, which is the manufacturing data. All right, OctaFX itself offers US oil, which is the NYMEX, UK oil, which is the Brent crude oil, and then we have the gold, the silver for clients who trade through CFDs. Okay, and then we have the equity index, right? I mean, you guys heard me talking about, this Nikkei 225, CAC 40, DAX, you got your Dow Jones Industrial Average. These are what we call the equity index. It's basically just a benchmark index, and it's the weighted average of the top stocks listed in it. When we talk about Dow Jones Industrial Average, those are the top 30 stocks in terms of market cap size in America, and then it's going to get average and it becomes an index. Those are what we call the equity index. It basically gauges the market performance across the stocks listed in it. And we talk about the index, right? I mean, there's a lot of news about the index. If you tune in on the news channel or you read the newspaper, they're not going to tell you some random share just crashes or whatnot, but they're going to refer to the index crashing or the index rallying up, because it's just a lot easier to look at the index compared to individual stocks. If you don't have any experience trading the equity market, equity index is definitely the way to go, because it basically gives you the general direction of the market. Okay, the funny thing is, when we talk about it, without going through a CFD contract, you cannot actually trade those indices, right? You can take a look at them, you can refer to them, but you cannot actually trade them unless you're doing it through a CFD product, like what OctaFX is offering. So that gives you a plus. Instead of looking at Coca-Cola stock, McDonald's stock, Apple stock, right? You can choose to trade the index, which is basically the average of those stocks, or Dow Jones Industrial Average. You can do NASDAQ if you are interested in the American market. If you are more towards the technology sector, then you want to be paying close attention to NASDAQ. That's the advantage. Okay, so every country basically has their own index, but not all of them are openly accessible. I know the Indonesian market is not really openly accessible. I think a lot of these indices, it depends on the popularity and the demand. If a lot of people wants to be trading that or have an interest in it, then they are most readily available, and we do have those major indices, right? Like the Dow 30, as I mentioned before. You got your NASDAQ, your FTSE 100, your ASX 200 in Australia, Nikkei 225. Some offers the Nifty 50s, but it's losing a lot of traction. What happened before was Kospi, or the Korean index, was quite a major index, and Hang Seng. But right now, those two, I think they're still being offered, but a lot of interests are not there anymore. A lot of interests are what's going on in America right now. Okay, so again, trading these indices are generally easier for traders compared to trading individual shares, because once you technically don't look into the fundamentals of those individual shares, which is a completely different beast to us as a traders looking at the fundamentals. Okay, very, very different. So these are the equity index. All right. Okay, there's no crypto here, but I'm gonna, because I used to run crypto as a separate webinar, but if you want to know what crypto is, I'll just briefly run it down. It's basically a new asset class. Right now it's more on the adoption cycle. Because it's on the adoption cycle, a lot of changes are being made to cryptocurrencies. Bitcoin, for example, just got their upgrade in the past. I think it's the first upgrade in the past 4 years in terms of how the system works, in terms of how things are being mined. A lot of this are moving from proof of stake to proof of contract. So you have to understand, every cryptocurrencies out there, they have a different white paper, and that's going to affect how they're going to be viewed or valued in the future. Okay, but we'll touch that on a separate webinars. We're not going to go too deep into it, but just so you know, cryptocurrencies is basically a different asset class than currency. Sure, it has currency, but it's a completely different thing. Forex, or normal currency, or what we call a fiat currency, has an underlying infrastructure behind it. It has a long history, but cryptocurrencies is new. It's all digital. A lot of arguments out there on how safe it is, and is it really just a hype for price to go up that high and stuff like that. But again, going back to CFDs, what are the advantage of the CFD instruments? We can highlight that again. It's basically a 24-hour market for most instruments. You can basically wake up at night and be trading the Australian against the US dollar. If you are in America, you wake up at night, that's morning in Australia. You could be trading the Asian session, even if you are in the Middle East, or maybe you are in Northern Asia or in European countries. That's completely fine. But the logic behind all this is, and why it's surging in popularity, is that traders can choose their own trading hours. That's number one, and I don't want you to forget this reasoning, because that's probably what most of you guys are here for, right? The flexibility of things. But prove me wrong or maybe I missed something out, if I can get a reason on why you want to be trading Forex, do type into the chat and I'll have a look at that later on. But traders basically can choose their own trading hours. Number one, everyone has their own style of trading. You can be trading intraday, you can be trading as a swing trader, you can be doing it as a position investment, or you can be doing more of a scalping, which is getting in and out of the market quickly. Everyone has their own style and everyone has their own comfort level in terms of how they actually trade. Now, unlike traditional share market, CFD traders can find opportunity in both rising and falling market. And the reason why I asked people just now, if you have any experience in the equity market, tell me how hard it is to sell something in the equity market. Short selling is, typically frowned upon. It's not ideal. People look at you short selling the market as something bad. And the process of short selling the market in the equity market, it's really complicated. You have to basically borrow something, borrow a share before you can short sell it, and then you have to give it you have to pay interest, a lot of it, a high interest for that. One of the example this year was the GameStop incident where people are getting short squeezed. That's what's happening with GameStop. A lot of funds are being crushed because of that stock, even though it's more of a joke run started in the Reddit forums. Okay, but it picks up because it's all community based right now. Social media is playing a big role in it, and that's how people trade. People trade differently from what it was 10-20 years ago. When I first started out, it's limited. Not a lot of people know about it, and people that know about it, they trade it for a different reason, right? I mean, right now, if you're using social media and a lot of people are saying, hey, you should be buying Dogecoin and blah, blah, blah. And then all of a sudden you get involved in cryptocurrencies even though you don't understand cryptocurrencies, right? Or people say to you, hey, I'm making a lot of money in this new market called Forex, right? And then you just jump on and start trading without actually understanding what it is. So what makes it easy is because of leverage. It basically allows you to enter the market for minimum or less required capital compared to what it was before. Back when leverage was an issue or not known to a lot of people are not looking at trading the currency market seriously. All right, so I mentioned the word that Forex was new just now. It was basically a misunderstood as a new financial instrument. It's not new, guys. Come on. It's actually the oldest form of financial market. It basically originates from bartering and trading, pre-modern civilization, if you want to put it that way. Maybe back then it's like, hey, I'll give you 10 sheep wools, you'll give me some potatoes back. So that's more of a barter and trade. The modern currency is commonly referred to as fiat currency. There's a whole completely different history on it. But if you really want to know what is the first fiat currency, it's actually from China. Surprise, surprise. And it's always typically backed by the gold standard as well. Back when it first started, right now people are moving away from the gold standard towards more of a fiat currency where it's actually not backed by gold anymore. It's just based on valuation. Okay, so again, this market wasn't new. Sorry, it's not new. It's just not known to a lot of people because there's a huge restriction of entry back in the days. Leverage wasn't easily accessible. A lot of these brokers are not taking the risk on leveraging your positions, right? But it's more common right now. Things have improved. Brokers have brokers to provide liquidity for them. We call them the prime brokers. Basically, back in the days, it was basically up to fund managers, wealthy individuals, large organizations, investment bankers. They're basically doing that because they have the funds to do it in the market and make it meaningful without the use of high leverage. Okay. But when the internet started, publicly being utilized in the mid-1990s, I believe it was 1994, 1995, when the internet was actually introduced to the world, people start to figure out how to trade online and how to use leverage as a stepping stone there. So right now, it is very easily accessible to the public. Everyone can trade right now, regardless of what experience you have. We do have some protocols when it comes to registering someone as a client. You really need to understand what you're doing, because it's not for everyone. But right now, to put it simply, you can actually apply for an account and start trading within the day. So if you go to OctaFX website, for example, right now, click on the link in the description, set up your account. By the time I finish talking in about an hour's time, you probably are running with your trading account. All right, so let me take a look on some of the questions here. Less investment in terms of capital, right? Scalping, I want to trade Forex for learning new skill. That's good. Use it as a tool to pay your student loan. But make sure, Hana-chan, make sure that these are funds that you're comfortable losing with, because that does affect you a lot when it comes to the trading psychology. I tried demo account, but still couldn't understand the process. So your site, someone can trade for you. How real or possible is this? Someone trading for you. I believe OctaFX does offer a copy trading service as well. Trading to make money. Yeah, a lot of people are trading to make money. A lot of people want money. Can I transfer fund from my OctaFX MT4 to MT5? Michael, if you can help me out here, that would be great. GameStop incident, yes, find it amusing. I find it very interesting. In fact, I even look up courses on trading. Look, there's a lot of video contents in OctaFX channel. I have been doing a lot of these videos, but mostly those are in Bahasa Indonesia. We're in the process of probably looking into doing those for the English sessions. So, that's definitely going to be happening in the future very, very soon. Okay. So yeah, there's a lot of talk here about being flexible when it comes to trading Forex, right? So let's go on. Before I go on further in this presentation, I want you to understand a few things first, because I know some of you just started out and trying to figure out what's going on with some of the terms here, because you're going to be looking at this a lot, right? We got your bid price. This is basically the price you can sell a certain currency to a dealer or a broker. Asking price, this is how much they're going to be selling the currency to you. Then we have the liquidity, which I've been yapping about just now. But liquidity basically means the ability or ease of buying or selling an instrument, right? Liquidity is basically how fast can you get in and out of the market, because speed, to me as a trader, is probably the most important part. And if you are from an equity background, you'll feel it, right? You want to get at a certain price. Sometimes your orders doesn't get filled, but with Forex CFDs, basically your liquidity, it's kind of a millisecond thing, getting in and out. All right. Going forward, maybe not in this webinar, but going forward tomorrow and the Friday session, we're going to take a look at some of the term here. We have the long. When someone say, I'm going long on a pair, for example, I'm going long on cable. Cable meaning GBP USD, or the sterling versus the US dollar. That's buying a currency, right? If you're going short on the dollar yen, for example, that means you're selling the dollar yen or selling the dollar and buying back the yen. And then we have the pip. The pip is basically price in point. It's represented by the fourth decimal point or second decimal point in yen crosses. Okay, depending on the currency that you look at, what is the base currency, what is the counter currency, they're going to be appearing differently. But normally, it will be the fourth decimal point. For example, in sterling, let's say we talk about 1.4950. The last number, the fourth decimal point, is your pip. The fifth decimal point is what we call a fractional pip. So don't mix this up. Okay. In yen crosses, is normally quoted as the second decimal point, but you'll take a look at it. If you take a look at your bid price and your ask price, you'll take a look at the last number before it becomes a superscript, right? So that's how you tell the difference between what's a pip and what's a fractional pip. Okay. All right. So you have done Forex. I can assure you this, you have done Forex. If you have purchased something from overseas, you are taking part of that $6 trillion that we talk about that's happening during the day. If you're traveling overseas, that means you definitely traded Forex because your currency probably wouldn't work, or it's basically not, it doesn't have a lot of value, or it's hard to use in a different country, right? So if you have traveled or you bought stuff overseas, maybe in US dollar, most of it are in US dollar, then you have traded Forex, right? You've done Forex. So there you go. Class is done. Feel free to sign off. No, I'm just kidding. Okay, but you do understand the concept of trading currencies if you have done this. Okay, it's simply exchanging one currency to another currency. That is as simple as it can get. You know, that's the easiest way to break it down. Now, OctaFX as a Forex broker is definitely not that different from a currency exchange stall at the airports or banks that you go to that you say, hey, I want to buy a certain amount of US dollar. Here's my Indian rupee. Please exchange it to US dollar or Malaysian ringgit, right? Or pesos. That's basically Forex. Simple as that. That's the understanding of what the Forex market is. So let me give you a concept here. If I'm traveling from Sydney to LA, it means I need to convert my Australian dollar into the US dollar, then I can go shopping, right? Otherwise, it's really hard for me to spend my Australian dollar in America. So what do? I basically need to exchange my Australian dollar to American dollar, then I'll travel. So here's basically a breakdown of what a currency pair is. And this might be something that you take a look at it and say, yeah, look, it's not that important. Let's just get to the point. No, this is actually very important because how you rate a currency pair and the bid and the ask price is basically figuring out how much the cost of entry into the market that you have. So in terms of a normal currency pair like this, we have the Aussie at the front. That is what we refer to as a base currency, right? And then we have the slash, and then you got your USD at the back. That's your counter currency. So when you look at the price here, which is 0.8937, and then you got the ask price of 0.8939, there's a difference. And the difference of 2 is what we call the difference in pip, and that would be the cost price, because when you buy the US dollar, it means you're selling your Australian dollar. You're going to be looking at the bid price there. And then when you want to buy back your Australian dollar, you get it at a different price. So when you get in, automatically you're down with -2 pip. So that's very important on how big this pip is, which is we're going to talk about this at the end of the session when we talk about exotic and currency crosses. But you do need to understand how to read a currency. This is how you do it: your base currency, your counter currency, your bid, and your ask price. And as I mentioned before, the difference between this is basically your pip. That would be 2 pip in this example. How do I read this? It means 1 Australian dollars is equals to 0.8939 US dollar. All right, that's how you read it. That even though we're looking at the 2 different currencies here, but we do know that the base currency at the front is basically how much it is compared to the counter currency, which is going to give you that equation here. For example, for every Australian dollar, it is 89 cents and 39 USD. Right now, I believe it's about 76, 78 cents. Okay. All right. So simple. All right. So let's move on. If Aussie USD price is 0.8939, a 10 pip movement will change price to 89.49. Look, it's not even 1 cent, guys. It's 1/10 of a cent. To move 1 cent, it means moving 100 pips. Okay, 100 pip change will move price from 89.39 to 90.39. That's 100 pip, and that is 1 cent. So when we listen to the news and the anchor says, oh, the Australian dollar falls 5 cents, today. Wow, that's 500 points, 500 pips. That's crazy big, right? That's why when you listening to the news every night, look at the price movement. It's typically either the same or they say 1 or 2 cents max, right? That's basically what it is. For every cent, it's 100 points to you. Now, for every 100 points to you, when we come on later in the evening, we talk about how much it costs per pips. That's going to be dependent on your lot size, but we basically count it by micro, mini, or standard lot. All right. So get that in the picture. It's pretty easy. So here I am again stressing that the concept of currency trading cannot get any simpler. If you think the Australian dollar is going to get stronger versus the US dollar, then you definitely want to buy the Australian dollar and you want to sell your US dollar, right? It just makes a lot of sense. So a lot of this so-called complex understanding of the market is actually not that complex if you break it down to a very logical pattern, which is, this is like common sense. You think the Australian dollar is going to get stronger because you think the Australian economy is stronger than the US economy, then you want to buy Australian dollar. If the Australian central bank starts rising the interest rate, that means an inflation is going on. While the USD, let's say they're staying flat or they're cutting down interest rate, then you can tell the difference there. One economy is growing, is facing an inflation. The other one is slowing down. That's what we look at the inflation numbers for. Then you can tell straight away what currency pair you want to buy. So let's break Forex down to the simplest form, and this is what you're going to get, okay? You think a certain currency is going to go up, buy that currency, sell the other currency. Simple as that. If you think your Australian dollar is going to be weaker by the US dollar very soon, let's say you heard rumors or stories about potentially the Australian government or the Australian Central Bank is going to cut interest rate next month, then you want to get ready, you want to get rid of your Australian dollar and you want to be invested in the US dollar. So simple as that. Okay, so it goes both ways, right? You can buy or you can sell. So let's go back to this and I'll show you how you start making money here, right? I mean, if you're traveling overseas, you exchange, for example, 1,000 AUD to USD, then you get at the rate of 89 cents, basically for every 1,000 Australian dollar, you get 890 USD, right? Simple as that. Now, when you're away, the Australian dollar weakens. So you're currently holding US dollar right now, right? Because you exchanged your 1,000 Australian to 890 USD. So let's say you're away or you bought this and then the Aussie dollar crashes by 1 cent. It's now trading at 88 cents instead of 89 cents. Now, assuming you didn't spend this money and you come back to the situation when you convert the Australian dollar back, you basically get $10,011.36. You just made a profit of $11.36 out of this, right? That's basically the concept on how a Forex trade works and how you actually make money in the market. And you can take a look at this example. Spend 1,000, market drops by 1 cent or 100 pips, you'll earn $11.36. Now you're gonna be thinking this. Look, you're talking about me putting 1,000 and then earning just $11, right? It's only 0.01%. It's not worth the time and investment. So this is where it gets really interesting, because if you have the same scenario, but instead of having 1,000 as a capital, you're exchanging 1,000,000. Your profit will be 11,363. It's still 0.01 of the capital, but you can feel that you're earning $11,000 instead of comparing it to $11, right? Now we're still not talking about leverage here, but this is the reason why it was previously reserved for the wealthy or for the banks or for the fund managers, because they're doing trades in large numbers, so big that their profit looks, it's worth it. But $11 was not worth it. But if you invested 1,000,000, it'll be 11,000. Mentally, it's just okay. That's a lot of difference there. We're talking about a couple of dollars here to thousands of dollars. That's definitely a different mental perspective. Okay, so this is why it was basically reserved only for the wealthy, big corporations and bank. So their investment is not, we're not talking about $1 million here, but they typically go into the billions here, making their gain worthwhile and relatively safe investment to their capital. I mean, 0.01% of their gain or loss, it's not really a big thing, right? That is until people start using leverage. Now, leverage is a very important thing that we need to talk about, and I cannot ignore this. I need to stress it out to you. It's basically a tool, right? A tool. Okay, so don't take it for granted. It's a tool to amplify your potential gains, but at the same time, it also amplifies your losses. It is a very useful tool to help traders lacking the capital to make significant gains in the market. Right, this is what makes Forex interesting, because you can leverage a small capital to hold a bigger positions. You know, OctaFX, I believe 500 to 1 was the highest. It's the highest right now being offered. Correct me if I'm wrong, but Michael can help me out there. But typically we're looking at 200 to 400 to 1 leverage. So this is probably a new concept to a lot of people, but I want you to understand how leverage works, and you really need to understand how this leverage kick in, right? So this is how it works. Let's take a look at 400 to 1 leverage. Okay, to open a position of $1 million, you will only need 2,500 to start with, because 2,500 times 400 is $1 million. That's the logic, simple as that. So instead of needing to have $1 million sitting in your bank account, you only need 2,500 as your margin requirement. Now this is what we call margin required, and this will be set aside from your capital. Therefore, you will need more than 2,500 to be able to open a position, because otherwise you're going to be taking all of your funds into the margin required part, and then you are immediately going to get a margin call. So let's say you have, $5,000, for example. Then you can start doing this on a leverage of 400 to 1. The higher the leverage number is, the smaller your capital requirement will be. Okay, that's a plus, and that's also a minus that we are going to cover. Okay, it's when used correctly, this is going to be a very useful thing. So don't take leverage for granted. You really need to think about it as, okay, this is a tool to help me. Do not abuse it, right? So, for example, people having a party, they start drinking beer, that's fine, right? It's just a gathering, it's completely fine. If you do it over the required or over the limit, then you're no longer drinking for fun, you become an alcoholic. So having too much of a good thing is actually a bad thing, and this works the same in terms of leverage. Probably alcohol consumption is probably not the best example here. So for those that are under 18 years old, you're not supposed to be here anyway, I think. Anyway, if you use leverage correctly, this is going to help lower your minimum capital to get started. And this is basically why people are trading Forex through leverage using CFDs. Simple as that. Okay. But I need to remind you, while it also amplifies your gains, it will also amplify your losses. Taking the previous example, if you do 1 million, right, unleveraged, your profit is 11,363, correct? But if you compare to how much money you put in, which is $1 million, this is 0.01. But if you are starting out with a capital of 5,000 and you're starting to earn 11,363, that would equate to 227.26% gain in one transaction. That is a lot of gain. Okay, if you are from the equity market, this is a number that will be super magical. But in the currency market, like if you're doing Forex, CFDs, contract for differences, this is a very common numbers, although a bit extreme, but having a 227% gain in one single trade is not out of the question. It will be out of the question in the equity market unless you manage to get in on the GMA stocks. But hey, you know, if you can get in on the GMA, it doesn't necessarily mean you can get out of that stocks. All right. So that's all good if you're correct. But if you're wrong, unleveraged is only 0.01, no big deal. But if you are leveraged, the loss will be more than double your 5,000 starting capital, right? Because you'll be losing 11,363. You're gonna be owing. But here's a good thing: there's a backup or a fail safe trigger here, which is your margin call. If it drops down to a certain margin requirement, you're gonna be cut out of your position before you can even reach zero. So having adequate capital, using leverage, that's also another thing that you need to consider into your trading plan. If you're starting out and you think you're going to convert, let's say 100 to 10,000 in a matter of a week, no, that's not going to happen. I can tell you right now, that's not going to happen. That's not the mindset that you should be having. If you're investing 5,000 or 10,000 and you start thinking, all right, maybe if I can make back $100 a week, $200 a week, maybe up to $500 a week, or maybe 1,000 a week, that's still reasonable in a context where it's a reasonable goal. But if you're putting 100, over leverage yourself, betting everything on one position, you're gonna get destroyed easily. So that's another perspective for you to think on how you want to use your leverage, because it's gonna be there to help you or it's going to be there to destroy you. Okay, it's a double-edged sword. All right, so we talk about margin calls. Basically, when your available margin hits 25%, you'll receive a margin call warning, and then a stop out will be triggered if your margin level goes below 15%. Okay, this is basically after your margin required, then you'll have the remaining, or what we call the available margin. Make sure you maintain this level. 25%, you're going to get a margin call warning. Below 15%, you're going to get stopped out immediately. So there are several ways if this comes up. Okay, it's either you plan your trade, you manage your risk before entering a trade, you know how big your position size is. Maybe cutting down your position size, that's going to cut you back on some of the margin requirement. Or maybe exit some open positions. This is going to free up your margin as well, which is your required margin. Or if you want to maintain your position, but you get this warning calls, then you can also deposit more funds to maintain your margin level and keep your position running. So margin level, the basic formula is this. It's basically your equity divided by the margin, multiplied by 100. That's your margin level there. All right, so here's a quick leverage and margin required comparison table there. Position size of 10,000 as a standard here. We're taking a look at a standard lot. Is this a standard lot? It's not a standard lot. Standard lot is 100,000. This is a mini lot, right? All right, if you're on leverage 100 to 1, your position size is 10,000. Your required margin is $100. Simple as that. 200 to 1 leverage, your required margin is 50. 300 is 33.33. 400 is 25. See what happens here. The higher your leverage number goes up, the lower your required margin is to open a position will be. Okay, so it can be a good thing or it can be a bad thing depending on how you want to use it. But feel free to screenshot this leverage table or review this video later on. It's going to be recorded, so that's completely fine. Don't worry about this. Take this slow. But this is a table that I live by, and I look at this, and this is a very good analogy or example on how leverage works. Okay, same position size, different leverage, different required margin. All right, so here we are. There's a lot of questions here already. Let me just look back at some of the questions. Because we're done with leverage, I need to move on to other things. Okay, You can start small. That's completely fine. It's just that starting small doesn't necessarily mean it's a good thing. It's just a step into it. You can start looking at the market. You can learn how to progress in the market. But that's basically that. You know, if you want to progress further, you want to stay safe, all this margin calculation, sure. The more the capital that you have, the less margin that the less leverage that you use, the safer it'll get, because you're not really hammering too much on your capital there if something went wrong. Why do I refer Forex as CFD? Because Forex, when we talk about the exchange that we're doing, is called contract for differences, and that's what CFD is. So when we talk about Forex, it's normally traded as a CFD product or a contract for difference product. You don't actually physically exchange your currency, right? So you're basically trading the contracts, the difference between the contracts between your buy and when you sell your position, or when you sell or you buy back a position. That's how you make profit in the market. You want to know more about EA programming? There's a lot of community-based EA programmings out there. If you have an idea for what you want to be doing, you can get into EA as well. All right, there are bonuses. If you want to open an account tonight, I believe you can click on the link and you keep register yourself for our workshop this week. There's going to be a deposit bonus. So yeah. How do you know whether you have to buy or to sell currency? We need to take a look at it from a couple of perspectives. We can take a look at it from the sentiment in the market, the supply and demand, which is more on the technical side. And then we can take a look at the news releases, which is the fundamental aspect of trading, which is something we're going to cover on Wednesday and Friday as well. Okay, which app is suggested? Okay, I don't know which app is this. I'm new and I like trading. That's good to hear. Copy accounts. I'm not really sure about how copy accounts is, but you can do that through OctaFX. Can someone I got fund in his account already get the bonus too, or I need to fund the account again before I get the bonus? I think that's gonna get, you need to fund account again. Yep. Pam pam pam. Welcome from Indonesia. Okay. Let me just look at the questions before we move on. Any questions that you have regarding leverage, please feel free to ask me that. Okay, we're not gonna give away market outlooks. We're gonna go through the basic here. So I need you to understand the really basic stuff here, get you refreshed if you are sorry, don't worry about drawing me back. Can you kindly explain more on the difference between CFD and cryptocurrencies? Sure. CFD, it's basically just a form of trading something, right? For example, currency, you can do spot exchange. You can go to your bank and say, hey, I want to exchange my currency. What is the market price right now? I'll pay you a commission and I'll take that. Unleveraged. Okay, that's one way of doing things. The other way is using leverage and doing it through contract for difference. You're basically looking at the difference between a contract. Now that applies to indices, that applies to equity, that applies to commodities, and this will also apply to cryptocurrency, right? You can either exchange it through the coin exchange, okay? Or you can do it through CFDs and trade it just like currencies. Okay, that makes sense, right? So CFD is basically just a method, a platform, or a trading style that you can use to access these markets. So yeah. Layering, I believe you're talking about martingale. We're talking about strategies there, but I can definitely not recommend you to martingale. Okay. Margin call is when you fall below your margin requirement to hold that position. That means your fund is not enough to be able or guarantee that you're not gonna go into the negative territory, then you get your margin call. So it's actually there to prevent you from going negative and owing the broker or the banks or whatever whoever you're trading with. That's the purpose of a margin call. It's basically just a warning sign. Okay. Margin required is the margin or the amount of money that you need to have to open a position. Margin call is when your remaining equity doesn't have the it doesn't have the amount that is required to hold on to your position. Basically, your required margin is your guarantee. Your margin level is how much funds that you can guarantee your position before you start owing someone something. That's how I can put it simply. All right. Margin required is how much you need to have set aside to open a trade. Margin call is when the amount that you set aside is not even enough to hold on to your position. You're going to be facing a lot more losses. Then you get your margin call warning and whatnot. Yes, your account is in danger. How to exit hedge calls depend on how you want to hedge. You want to do a perfect hedge or you want to do a cross currency hedge. There are different strategies for hedging. What is Forex market? It's not dominated by a single market or single someone or single person, and it is worldwide. Yes. Okay. What is the difference between CFD and spread betting? Okay. Spread betting, it's completely different from CFD. They used to be lumped up together, but spread betting, it's, look, you are betting. When we talk about CFD, we're talking about calculated risk, right? Spread betting, when we first started out online trading, I can tell you a little bit of experience here. The spread from brokers to brokers, they are different, okay? And sometimes we can take advantage of that spread. It was basically huge. It was like, if you want to trade sterling yen, I believe last time it could be up to 8 pips in terms of difference. So, you know, a lot of this are basically just taking advantage of the spread changes in the market. Right now, it's really more of a variable spread, right? So you can take a look at it, and you can take a look at the Euro USD right now. If you take a look at the spread, it's typically 0.5, 0.1. You don't even get 1 pip in terms of spread there. Okay, so spread betting is actually a very old term. Before it was classified as contract for difference, because it'll give you a different understanding of how the market works. If you want to talk about tax, then it will be income tax as an individual, or what we call a capital gain tax. And I'm not here to advise you on taxation rules over in your country, but different countries have different taxation rules. Typically, capital gain tax has a little bit of an allowance there. You can earn so much before you get taxed. So that's quite a hint there. Required margin is not the same as required starting capital. So let's say you have 5,000 capital and then you want to open a position that requires 2,500. When you open that position, you're left with 2,500 as your required margin. Your 2,500, the other 2,500 is your equity, all right? Which is a better master to copy trade? We're going to take a look at the copy trading site, basically straight from the website, and how to filter which one is actually winning and whatnot next week. So yes, don't worry about coming late. This is recorded. All right, so let's move on. How do we know when to buy or when to sell, right? What I've given you so far is basically just a basic understanding of the financial market. It'll help, right? everyone can get started with limited knowledge. Right now you can do that straight away, but there are multiple ways to identify opportunity in the market, and there's a reason why OctaFX does provide a lot of education in terms of how to use a strategy, how to use an indicator and whatnot, because that's gonna play a big part on how you look at the market. Now, I myself, I'm a technical analyst. Doesn't necessarily mean I'm gonna ignore fundamental analysis, and I'm gonna completely ignore the psychology of trading, right? But I put a lot of weight on technical analysis in terms of how I get in and out of the market, and that's why I'm called a technical analyst, and I'm trading the market based on this technical knowledge, right? So technical analysis is probably the easiest way to get into the market, because you basically look at the price movement and you rely on those past information to basically identify future potential movement in the market. That's the basic of technical analysis. When we talk about technical analysis later on in future educational webinars, then you'll understand that it completely branches off to other things. But for now, just keep it simple, okay? Looking at price movement, that's going to give you the basic understanding of the market. What's happened in the past is basically going to affect someone's psychology or a trader's psychology in the future. Using technical analysis, you can actually get in and out more accurately than just randomly guessing when to get in and out. Okay, there is a minimal knowledge of financial markets required. You don't technically need to understand the economics of things. You basically need to be really good at understanding the concept on the technical strategies, on the technical indicators that you're using. If you understand that, that's all you need. When we take a look at the fundamental analysis side, then this is where it starts being a little bit harder, because obviously we're going to be looking at economic data. We're going to be looking at political view of different countries, right? We're going to be looking at geopolitical tension. If there's a war somewhere, how is it going to play out? How is it going to affect the currency? How is it going to affect the economy? The global pandemic hits. India was hit the hardest. Economy, how's the economy is going to recover in the future? That's all the big question, right? I mean, the pandemic basically hits everyone hard enough, but some countries are hit a little bit harder, and those countries are put into question. How are they going to recover? First of all, they need to fix their current situation, how to stop the spread of the infection of COVID, for example. Once that happens, what's the steps, the unemployment numbers, how to bring it down, the inflation numbers, how to get it up, but not get it up too quickly. Otherwise, it's going to be bad because people are not working, and then things are going to get more expensive as the inflation grows. So those are, the questions that you're going to be asking when we look at the fundamental analysis side. Okay. Fundamental analysis cannot be ignored because it'll give you a reliable view of the bigger picture or the market direction. So this is something that's what we call a fundamental delay. It could be 3 to 6 months delay from what we find out today, because we're not going to be seeing that impact straight away. You are going to see the impact of a news straight away, but it's typically not going to last very long, but the long-term effect is not going to be felt until 3 to 6 months later. Okay, so let's give you a little bit of an example here. How do we digest information? We got a US stock market crash. This is taking the global financial crisis. For example, this is 2008. Started with the subprime mortgage crisis back at the end of 2006. So investors pull out and seek a better performing market in the US, right? The Australian market, for example, the Australian was actually doing pretty good. It wasn't hit as hard as America experienced, right? So let's take a look at Australia moving an investment from US to Australia in terms of stock, maybe, or real estate investment, but basically you need to have the Australian dollar to invest in Australia. That's simple. So we speculate, or we predict, that we think that the market, whatever language you want to use, that US market is going to continue to deteriorate, and USD is going to be weaker because of that as money leaves the country. Okay, so when money leaves the country, when we talk about money leaving the country, a lot of people are selling the US dollar position. to buy other currencies, the US dollar is gradually going to get weaker and weaker. So if money comes into Australia, into the Australian economy from overseas, this is what we call a foreign investment. That's why when you read up the news, if a foreign investment happens, then it's good news, right? Foreigners are investing in your economy is going to grow. Your currency is going to get stronger as all these investors come in. They need to have your currency to be able to invest in your country. So in the case of Australia, in this one, the Australian dollar is going to go up and the US dollar is going to fall, because we take a look at the comparison between the two economy here. The Australian economy is stronger, more stable than the US economy. That's why during the global financial crisis, believe it or not, the Australian dollar was higher than the US dollar, even for a few months. Okay, just for a few months, it was at parity, and then it was actually more expensive than the US dollar. So what to look at, other things to look at, right? Another reason why share traders are moving away from share trading into and moving into the CFD market is due to its simplicity, right? In the share market, there are going to be thousands of shares to choose from, if not hundreds, right? And this is going to confuse a lot of new traders and investors on which share to buy. Don't lie. You look at the equity market, you look at the stock market, I can assure you, you are going to get confused. I mean, Indonesia, for example, I believe there's about 600, 700 listed company. Some of these listed companies are rubbish, right? How are you going to filter out 600, 700 companies to figure out what's good, right? You can take a look at the index and you can trade what's on that index. This is what we call a blue chip investment typically, because you're investing in a large cap companies. But it does create a lot of confusion because it's complex. You got to take a look at those individual stocks and you have to decide whether the company is healthy or not, how much of that research is going to go into. But if you look at the example that I just gave you in terms of Australian economy and the US dollar economy, the US economy and the Australian economy, you can tell straight away which one is going to get stronger, which one is going to get weaker. It's easier. Now, the other thing is that you can trade the global indices. All right. This is an average of shares. It basically allows traders to focus on these indices instead of those individual shares. Like I mentioned earlier, you want to look at the, how healthy McDonald's is, not the food, right? The company, how healthy McDonald's is, how healthy Coca-Cola is. You got to look at those companies. You got to look through their earnings, you got to look at their expenses, you got to look at their liabilities, you have to look at their assets. There's a lot of these things that you have to fundamentally consider before deciding on what to invest. So there's a lot more homework if you're going to be doing the equity markets. It just gets really complex. Okay. So CFD markets, there are going to be instruments that dominates, meaning they're actively traded daily across the globe, right? For example, currency, we have what we call the major currencies. You got the Euro USD, you got the Sterling, you got the US dollar, you got the Japanese yen, you got the Australian dollar. What other crosses majors out there? You got the Swiss, Switzerland franc. Those are major currencies, right? You can actually just trade those major currencies because that's what a lot of people are looking into. Okay. So basically, there are instruments that stands out. There are more instruments that are being traded out there. So these are your main focus as a beginner. You don't want to be looking through, you guys from South Africa, your currency is considered an exotic currency because it's not actively traded. Okay, it's not because there's no attention to it. It's not invested by a lot of people. People take a look at I believe it's the South African rand, right? They are not a major currency. It's different. It's not being used actively as the world economy trades. It's only going to be used if you are trading with South Africa. If you're not trading in South Africa, for example, but even if you buy stuff from China, you are most likely going to be trading in the US dollar because it's much more of a preferred currency, and it's actually an international reserve currency, and that's where the standing is. So if you take a comparison at a US dollar, for example, with Malaysian ringgit, you can tell straight away the difference, of the power that they have in influencing how the market works. Okay. So these are the major pairs in Forex. As I mentioned before, you got your euro versus the US dollar, which is simply called the euro. You got your Great British Pound Sterling, or we basically call them sterling, or cable, just because of the cross-Atlantic cable that goes through underneath. Then you got the Australian dollar, or we call the Aussie or the Oz. You got your US dollar yen, then we just call it the yen. You got your dollars versus Swiss franc, which is just the Swissy. You got dollar versus Canadian dollar. You got the loonie. Do we have a Canadian here, or anyone that lives in Canada? If you guys are from Canada or live in Canada and seen a dollar coin, there's a picture of a bird, and it's called a loonie bird, and that's why we call the US dollar Canadian as a loonie. Not commonly called that way, but yeah, likewise with the New Zealand dollar, we call it a kiwi because there's a kiwi on the coin, right? A good thing Australian dollar is not called a platypus because I think on the 50 cents or 20 cents there's a picture of a platypus. All right, so these are your major pairs in Forex. And if you're just starting out, please stick to these majors, okay? Don't go exploring other things until you get more proficient or in understanding what you're dealing with, okay? But if you're just starting out, this is where you want to start out. Pick from these 7 pairs. That's more than enough. Okay? All right. Then we have the minor currency pairs. These are called currency crosses. These are basically currency pairs that excludes the US dollar. Example of this are the euro pound. It's basically the euro versus the sterling pound. Sterling pound. The euro versus the Japanese yen, sterling versus Japanese yen, Aussie versus Japanese yen, euro versus the Aussie, Swiss versus the Japanese yen. These are what we call the currency crosses. So any currency that doesn't have US dollar at the end of it, we typically call them currency crosses. So in terms of how hard they are or how illiquid they are, how volatile they are, major currencies are typically very stable. They're not very volatile. Some are more volatile than the others, like the sterling. It's my favorite currency because it's volatile, and as a trader we have the need for a market to be volatile to be able to make money out of it. Okay, so the sterling is more volatile than the euro USD. Sterling yen is more volatile than the dollar Japanese yen, so you have to understand the volatility of each of these currencies. But then we have the crosses. These crosses are typically more expensive to get into. The spread are typically higher. In terms of liquidity, I think it's okay. The currency crosses are okay. The euro pound has different valuation. Typically, 1 pip is not like $1 or $10. It's valued double than that because the euro and the pound is a lot more expensive than the US dollar. Euro yen, sterling yen, they move a lot faster than the euro USD or the sterling USD. Okay, Aussie yen, we used to trade this as a carry trade, so we basically buy and hold the position because Japanese economy has close to 0% interest rate since the 1980s, I believe. So it's been like 30 years right now. The Australian economy has a higher interest rates, right? So the difference between the two interest rate is what we call a carry trade. We basically get interest for holding Australian and Japanese yen. There was an unwinding of this. It's no longer popular. If you take a look at the global market in terms of interest rate, a lot of the countries are very close to 0 or 0.25%. So carry trades are no longer interesting, but it used to be very, very interesting. We just used to hold on to Aussie Japanese yen, and day by day we just get interest earned on it. Okay, you got your Euro AUD, which is borderlining on crosses and exotic because not a lot of people look at the Euro AUD. Swiss Japanese yen is also not very popular. Okay, And we took a look at the exotic currencies. Someone was from Turkey just now. The Turkish lira is considered to be an exotic currency. The Indonesian rupiah is an exotic currency. The Thai baht is an exotic currency. Malaysian ringgit, exotic currency. Filipino pesos, Indian rupees, Brazilian real, to name a few. I believe the South African rand falls into this as well. These are exotic currencies because these are currencies that are usually associated with developing countries. All right, that's not a very fair term to put it. Like we don't really call the Singaporean dollar an exotic currency just because some of you guys are from Singapore, some of you are from Malaysia, right? And some of us are from Indonesia. We're very close to one another, but we're classified differently. We don't consider Singapore dollar as an exotic currency for some reason. But Malaysian ringgit, the Thai baht, the Indonesian rupiah, the Filipino pesos, and the Indian rupees, we fall under that exotic currencies. A bit unfair, but that's the reality of things. Singaporeans here, you understand how your currency works, right? Your currency is typically pegged to a US dollar. Your government, it's MAS, right? Monetary Authority of Singapore. They basically peg it. So it cannot fall below a certain range. It cannot go up beyond a certain range. So the Singapore dollar is actually pegged. The Hong Kong dollar is also pegged to the US dollar, I believe. Okay, so these are your major, your minor, your exotic currencies. All right, let's take a look at more of this. All right, major currencies more commonly traded, leading to high liquidity because a lot of people are trading in this. Okay, so you have to understand that the high liquidity, the better it is. Non-exaggerated volatility or price movement, because of this, they usually have a lower spread. Simple as that. Cross currency are usually not USD based, as such has a different pip valuation than normal USD, as I mentioned before with the Euro Pound. They are also not commonly traded like the majors. They have a higher spread, some lacking volatility. If you take a look at the Euro Pound chart, and it doesn't move much. Within the day, maybe it moves less than 100 pips, or maybe less than even 50 pips. But if you could open up sterling yen in one day, it'll move more than 100 pips, maybe 200 pips. Okay. Exotic currencies, again, not commonly traded, therefore lacking liquidity, causing them to have a higher spread. So put this into consideration, that the moment you open a position, the spread is going to count into it. The majors have a lower spread. That means your immediate loss or the cost of entry is lower. Your exotic currencies are going to have a much higher spread. That means immediately when you open a trade, your negative is going to be your cost, and the cost is definitely going to be higher. Movement on these pairs are a little bit weird. They're exaggerated. For example, the Indonesian rupiah only move like once daily. Throughout the day, it doesn't move, but the next day it'll just jump up and down. Same like the Malaysian ringgit, I believe. The Singapore dollars are pegged or controlled float, we want to call it. So these pairs are usually harder to analyze, and predicting price movement and range carries a higher risk than major currency crosses, because somehow the government still has control on the currency. That's number one. Some of them are pegged, they'll move differently, there's a different fundamental driving it. So all this needs to be taken into account when you open a position, right? So you got a major, your currency crosses, you got your exotic currencies, they're all different. If you're new, do start with the major currencies. That's going to help you a lot. Okay, so before we wrap up, I just want to give you a little bit of a sneak peek on what we're going to be covering this week. So if you haven't signed up to the series, there's a link underneath under the description. If you want to get your deposit bonus as well, do register from that link for the series this week. Okay, your second workshop, which is on Wednesday, is basically a brief look into your technical analysis and understanding how to actually trade, open like literally opening and closing a trade. Your third workshop, which is on Friday, will be a brief look into fundamental analysis, what is fundamental analysis, and some basic risk management. This is covering on your position sizing, your margin requirement. If you have a lot of questions on what is a margin call, what is the required margin, we're going to touch on this on the third workshop, which is on Friday. All right, In order for you to follow along for the second workshop, I need you to be registered for an account or have a platform up and running. So because I'm going to go through a platform rundown, how to actually open a trade, close a trade, set a stop loss, set a take profit, set an open order, a close order, and whatnot. Okay, so you do need a trading account, or you need a platform to be able to run it, whether it's through your mobile phone. I recommend that you do it through your PC. Mac, I don't think you can do that on Mac unless you use Wine or maybe a Parallels. Then you can do it on Mac. But if you can do it on your PC, that'll be great. If you can't do it on your PC, then do it from your iOS or from your Android. That'll be fine. You can use the MT4 platform to do that. That's completely fine. So either you want to put in, you want to start in with a small account, that's better, or you can create your practice account or a demo account to test out whether this is the right thing for you. But regardless of what you want to do, you need to have an account for Wednesday session. Otherwise, we're going to have a lot of trouble, or you have a lot of trouble following through what's going to happen. Okay, so this is just a quick look this week to start with, not to overwhelm you. If you're still overwhelmed by margin call, margin requirement, that's going to be answered on Friday. You want to figure out how to get in out of the market using technical analysis. We're going to touch on some of the basic on fundamentals on Friday. All right, so Q&A session. If you have any questions, feel free to ask about tonight's session. If you're not sure about margin call, margin requirement, that's the whole point of tonight's session, to keep you intrigued, and you come in on Friday to finish up the workshop, okay? Because we're going to cover that on Friday. All right. This guy experience on that. I know him explain very easy. I'm seeing this guy from 2015 again a lot. Oh, thank you, Fahan. Hana-chan, if you want to practice on demo account, sure, do that. But just don't do that for too long. It's going to affect your psyche in the long run. We're going to take a look at copy trading on Wednesday as well. Is there any guide to OctaFX app for Android? I think there's a video, right? If I'm not mistaken, there's a video on that. What's equity? What's equity? Equity is basically your total balance minus your open profit or open loss. That will be your equity. We're going to touch on equity again very, very soon. Is there any levels to enter a market? Yeah, there are certain levels to enter the market. We got to predict that. We got to figure that out as our trading plan as well. Everyone say which is your favorite currency? Well, that's a very good question. If everyone can say that, that'll be great. Mine is pound USD and sterling yen. All right. Demo account or real account? I would prefer real account, but trading on a micro lot, it helps a lot with building your psychology in terms of trading, because at least, even though you're losing maybe 10 cents, 1 cent, it's still your money. It's real money. That's going to help out with you accepting that there is going to be potential losses happening, not just the profit. We just went through this in Bahasa, Indonesia last week, that when it comes to trading, you gotta figure out that yes, I'm doing this for the profit, but at the same time, you have to accept that you're gonna be facing losses as well. So losses and gains are equally important, and that's gonna affect your psychology when it comes to trading. You can, margin level between trades and Forex market. Yes. How can you deposit more? I believe you can do it from the OctaFX website, and it's recommended that you do it only from the OctaFX website. Okay, good. Workshop on copy trading. I'm gonna cover not like the whole thing, but just briefly touch on how you want to filter out and find out who's doing great. That's gonna get covered on Wednesday. Okay. I don't know how to trade. How would you help me out? Well, Shehu Musa, you can start out with attending this week's workshop and see if this is for you. If it is for you, then there are more videos to help you out in terms of looking at the market. You just don't join late. That's fine, Philip. This is recorded, so you can just do this again. Give me the link, customer service, Indonesian. Michael, if you can help out with that, that'll be great. Promotion code. I don't think we're gonna be using promotion code, right? All you need to do is just follow the link on the description. Register for the rest of the week's workshop. I believe you'll get a bonus if you open an account and deposit this week, I believe. Margin is basically just for everyone that trades CFDs. It's not just for overnight trades. Overnight swaps is probably for the overnight trades, yeah. Okay, why do we trade XAU USD? Why not XAU Euro, XAU GBP, XAU other currency? You can actually do that in other currency. It's just that not a lot of people just, it's not common. Because when you take a look at gold, you typically associate it with the US dollar. So if I open up my Reuters, then I can take a look at XAU IDR, for example, XAU Euro, but it's just a converted number. The typical standard would be gold versus US dollar. It's just that because the US dollar is the international reserve currency. It just makes things a lot simpler, that's all. For the next session, is it okay to trade? No, hold on. First webinar, looking for next webinar. That's awesome. Webinar is awesome. Thank you. You're awesome too. For the next session, is it okay to trade on Realcom? Feel free to if you want to. You can learn along. So it's easy to go to OctaFX, open an account, start trading. Yep, just follow the link down there. Copy trading is just follow. It's basically like fund management. You basically trust someone to actually trade for your account. If they trade badly, then that's gonna affect your account badly as well. So I don't really have any say in that. I'm more of a I'm being responsible for my own trade kind of guy. Happiest moment and saddest moment in trading. It's really hard. The happiest moment would be my first win that makes me decide to leave my job as an auditor. Saddest moment is obviously my first margin call when I got devastated because I don't understand the risk management aspect of trading. So yeah, all happens within the same year, within the first 3 months. Yep, get the bonus. You need to subscribe to the webinar. There's a link there. That's where you get the bonus. So register, subscribe for the webinars. You're gonna get your bonus, okay? I am about done with the presentation. That's fine. You can rewatch this again. So for Indonesian, all link to OctaFX website just change to .work. I'm not sure about that. Michael can probably help out for Indonesians. I created my account through my Binance wallet. Can I withdraw to my local account? I'm not sure, depending on your regional location, that's going to change. Is there a calculator for OctaFX? Yes, we're going through OctaFX website tomorrow, so we're going to look at a few of these economic calendars out there, trading calculator, margin calculator. Remember, tonight is just me touching on these topics, right? We are definitely going to go deeper into the margin requirement, the margin calculator, etc. This week. So we are going to touch base on some of the stuff that we talked about tonight. And then we're going to expand it even more. So not to give you a heart attack or a shock that, oh, there's so much information here. Yep, that's fine. This is, yeah, I mean, look, everyone lost, right? So we were just talking about this in the session last week, that we actually have to embrace our losses as well, not just profits. So yeah, I was profitable, and then I decided to quit my job, and then because I was chasing just a small amount of dollars there, like $1,000, I was risking all of my capital because I don't quite understand the margin requirement as well. Don't quite understand how big a position I was opening. I was opening $100 a pip position when I thought that was the norm. The norm is the standard lot size is $10, so I over leverage. I miscalculated my position, and that's where I pretty much lost it all the first time around. Using robots for trading is useful if you know what you're doing, you know how that robot works. So for me personally, I don't trust others. I would code my own, then that's fine, because that was my own strategy, that's my own trading plan, and I'm happy with that being coded. In fact, right now I'm actually transferring my brain into a machine learning program, but that's for my own use, right? So I'm not going to give it to anyone, so they don't even ask for it. So you can use EA, but make sure you understand what you're dealing with, because a lot of people have a lot of EA. Some of these EA are broken, some of these EAs are really good, I don't know. Okay, but test it out. Thanks, Albert. This workshop is superb. And to answer your comments on the last video, is 20% target a month reasonable? I think it's reasonable depending on your capital as well, but I think a number like that is reasonable. All right. We'll I guess there's no more questions, so we can wrap up tonight's session. I'll see you guys. Again, please subscribe for the webinar this week to get your bonus at the end of the week. The link has just been posted by Michael here from OctaFX. Thank you, Michael, for keeping me company and keeping us company for tonight. But we'll wrap up tonight's session. We're gonna expand a lot of this stuff on Wednesday and on Friday, so I'll see you again twice more this week. Yeah, we're gonna be looking at that on I believe it's gonna be on Friday, but it could be on Wednesday. I need to double check on the content. All right, guys, we'll just wrap it up. Thank you all for attending. I'll see you again very, very soon. Stay safe. And again, good morning, good afternoon, good evening, wherever you're from. Thank you all. The next one is going to be 16th of June and then 18th of June. See you around. Have a great day ahead.